All right, what's up, everyone? And welcome back. In our last episode, we added a powerful pattern, the filler swing, and now you've got already two high probability entries, the turtle soup and the filler swing. I am still sick. I'm recording this video really early. So, having a turtle soup and the filler swing uh, that just isn't enough because just having a pattern that is not it. So today we are going to talk about the most important part of trading, that is logic, and we're going to talk about the single most important question you need to ask yourself before every trade, and just as important, the most powerful pattern of all, that is when to stay out of a trade. The the most important question is the logic behind your entries. So, because this is probably the most important slide in the entire series, a perfect trade isn't just about the pattern, it is about the logic behind it, and you have to have an objective reason for every trade that you take. And there's one question you need to ask yourself every single time. It's a pretty simple question, but it will save you so much money. That question is, where is the liquidity? Where the chart is driving to? Is it driving to a liquidity point? Right? That is the only question you need to be asking yourself. You can, yes, of course, ask, oh, am I going to be mad if I lose this trade? That is stupid, right? Like, bro, obviously, if you lose a trade, you're going to be mad. You don't need to lie to yourself. Um, just how you react after to losing, that is up to you. Either you journal it and you learn from it, you learn why did you lose. Um, because even if you lose a trade, there must be something that, well, okay, if you are following one strategy and you lose because of it, you need to learn what happened and how to not, again, lose on that type of trade. You need to learn, you need to observe why did you lose the trade. And, right, so the question was, where is the liquidity? If you cannot answer that question, you have no business being in a trade. And I hope you're writing everything down that I am saying. So, because writing down is the best way to learn, you can write it on your notebook. Uh, it's the way how I learned. Yes, I know you can write on PC, but on notebook it just makes you, I don't know, feel more special, more better. Like it's just going to go down with you in the history, right? You're going to be older. You're gonna open up the notebook and see how you were learning and what here is going to come out, right? That you made the best decision in your life. So, so let's talk about the most powerful pattern, that is no trade. Is the highest probability setup of all because you don't lose any money and you don't earn any money. So that is also a trade. You don't lose anything and you don't get anything in return. For some, it might not seem like a trade, but it should seem like a trade. Because imagine, because think about if you were in a market and you just didn't take a trade, you're like, okay, nothing is happening, I'm not trading today. How did you feel? And how did you feel when nothing was happening and you still entered and it hit your stop loss? if it hits your take profit, you're gambling. Congratulations. But it's not going to happen over and over again. So, no clear liquidity target. If you look at the chart and you can't clearly identify a high or a low that the algorithm stop targeting, uh, you don't enter the trade. Uh, it's just random noise. You don't want to be trading in that. So in the middle of the range or accumulation. So we need to be avoiding trading when the market price is chopping around in the middle of a range. There's no clear bias, and you've essentially gambling again. So all you have to do is just wait for the price to reach a key high or low, and then you can make decisions. But let's say on 9:30 the market opened and hasn't taken the low or the high. You don't want to be entering a long or a short position because either one of those liquidities hasn't been taken yet. So you are just kind of guessing. Yes, maybe if you add confluences, it can work out. But at the same time, that is gambling. So no reversal signal. Don't enter a trade just because uh, you think that the price has moved too far. And you must have a clear turtle soup or a Hildersing pattern, or we're gonna talk about other confluences later. So, for instance, SMT or order block or fair value gap. But if none of those things happen, then you're not taking a trade. So, so here we are on a chart, and I'll show you a few examples that we can find together. So, actually, this Friday was pretty good. So, let's replay Friday. Here we are on 5 minutes. Let's look at 4 hours. This wasn't still here. So, let's look at 4 hours. What do we see here? I didn't take this trade on Fridays. That's why, as I did in the previous episode, I don't trade on Fridays. Except if something like really good is actually happening, clear travel liquidity. So this is how it was looking on 4 hours, 5 hours, 6 hours, 8 hours, 12 hours. Yeah, and you can see on the bigger range on 12 hours, we already cleared this liquidity right here. But still I wasn't being bullish because looking at a weekly candle, we are inside of this weekly range, right? You can see we took out the range high in this candle almost. Well, I was expecting this candle or the next candle to take out the range low. It seems that this candle just took out the 50%, maybe like 70% of the candle, 80, and is going to reverse. So okay, yeah, let's just see what happened on the market open. So oh yeah, if you're looking at like this, we had an intra turtle soup. No, a turtle soup, I mean. So you can see we took out this range right here. feather sync, and could have entered on this candle right here, but I was waiting for the market to open and take out the buy side and then go and target the lows. You can see how close we were. Uh, you can see 9:30. So we almost took it out, but not really. Pablo speaking this day, and yeah, you can see what the next candle did. It just went like this right up. Then I gave it like 10 more minutes, and nothing was happening. Just because of this candle, how many points was it? 311, right? So this was a no go, right? Because of news and just because of this. This literally gives us nothing, right? So Tuesday, did I take a trade on Tuesday? I don't remember. Let's look. So let's go to 9:30. 4 hours, no range. 5 hours, 6 hours. Let's go to daily. Daily range has been completed. Right here, took out the high. No. Took out the range low. Let's go on a weekly time frame. So yeah, same thing. Oh, we were in this weekly range. So it's 4 hours. Nothing here. So really nothing happening. So let's go to 5 minutes. So we don't really have a clear bias for the day. I mean, we can have and draw these lows out, right? And you can draw these lows out, but same thing, we don't really have a range. We are in a weekly downtrend. We already completed the daily range. Let's just look what the market did. So what we want to be seeing is candle taking out this buy side, and then we can go and target these lows. But again, the lead range has been completed. The lead range has been completed, and there's really no range on smaller time frames. So let's look what happens. There your market opens bearish. Right? Did it take out some kind of a liquidity? No, didn't. Maybe it took out these lows, but remember, on the bigger time frame, key levels are stronger. So what we have of a fair value gap right here, right? Or like, so let's just look what happens. Yeah, we go and take out these lows, and it's already 11 a.m. You can see that this is not it's not a market that we want to be trading at. Huge risks. Again, let's look at 4 hours. There we have these previous lows, but still, I don't really know if we can target these because remember, the daily range has been cleared. So I would just skip on this day and wait for the second day. So something similar happened. Which day was it? Yeah, it was this day, Wednesday, 20th of August. So let's play out from 9:30. This is a trade that I took. Okay, 9:25. Let's look at daily. There we go. So this range has been completed. We have these lows right here, right? On a daily time frame, so that's really good. They're really strong. Strong key levels. So 1 hour. Let's look at 4 hours. Let's look at weekly. Still. So hours. It's 5 minutes. No, let me go to 4 hours. So not really a range happening. 5 hours. 6 hours. So nothing really is happening right here. So let's go to 5 minutes. On this day, I was waiting. So on this day, I was waiting for these lows to get taken out. Because I was bullish for the day. And well, let's just see what the market did on open. Yeah, you can see it just started going down. So there really wasn't an entry to go short. There we go. What happened? We took 2 of these liquidity points right here. And my entry was right here on this candle. Put my stop loss below right here. And I think I made an X post of it. Yeah, there you go. So this is the trade, exact same trade that I took. Turtle soup key level, 5-minute order block, and I was going for a 1 to 3, something like that. One to 3.4, 1 to 3.4, something like this. There. Right, 3.41, and my exit was on this candle right here. And of course, you could have held it out longer. Well, I could have held it out longer, but I really didn't want to because 1 to 3 is all I need. And because I was targeting, I thought that, the market is definitely going to go to the 50%, the equilibrium of this candle, because look how many points did it fall? 400 almost. And you can see it reached the 50%. And really went up a bit higher. And you can see that it really chilled at that level. But yeah, 50% is an easy target, not this high, but a 50%. And for 1 to 3, if I was targeting the high, let's look. So I think this is my entry, right? No, or was it on this candle? Yeah, I think I entered right here. 136. So I want a 5, right? But I want a 3 is all I need. So here is also a common reason uh, why sometimes the market looks like this. So accumulation, accumulation, accumulation. First candle is 2 a.m. to 6 a.m. The next 6 a.m. to 10 a.m. The next 10 a.m. till 2 p.m. And there are three key factors that could lead to this. Unclear corporate outlooks is when companies provide uncertain or conflicting earnings forecasts, and investors are hesitant to commit to a direction. And geopolitical instability is global events like wars, trade disputes, or political instability, and can lead to the market being choppy. And of course, number one is bank holidays. So, in a market like this, we don't want to be taking trades. We have no clear travel liquidity, and the market is being choppy. What we want to be seeing is, let's say, the first one looks like this. Sure. Okay. Then what does this do? So we have manipulation. Hope I'm writing it right. So accumulation, manipulation, and it should look something like this, right? Well, actually, let's make like this. Right. And distribution. Now the thing is, sometimes this happens. So, no, sorry. Accumulation, manipulation, distribution. But sometimes we can. What I always like to do is wait for 10 a.m. Sometimes the market does exactly this. So 9:30 opens, takes out the liquidity, and makes a manipulation move. And what did it do? Reverses and creates a distribution. And distribution just goes up. Let me try it again. So this opens. Yeah. And continues going up. So this can also happen. So we need to look at 9:30. What is happening there? Because we can catch the move and enter right here. Or if we miss it too late, then we can look for an entry right here. So if we take our fib and look if the price goes to the 50%, targeting the high and the low. So if we take it like this, so we want to see the price, let's say it is up here, it is not really doing anything. We want to wait for it to reach the 50% and then enter on it. Not always that will happen, but you can catch trades like that. I'm also on the 79%. But I'm not going to complicate this. I'm going to talk about everything later. It's alright. Sometimes this can happen and you just enter on the 79. But the best case is if this is manipulation. So let's say the market just keeps on falling, right? Market does this, then this opens up and creates the distribution, something like this, right? So this is the best case scenario. I always try to wait for 10 a.m. Okay, we got this now out of the way, and yeah, I mean, I can show you maybe where did this happen. I mean, on the previous example that I showed already, was it this one? Yeah, you can see that kept falling. No, and on 1050 it started reversing, so going into the distribution. And let's look at yesterday. I mean, I already showed my trade entry yesterday, so, but I can show it again. Okay, what was yesterday? Yesterday was Monday. Okay. So, on 8 hours. No, it was. Or was it on 8 hours? Wait, I don't remember. Hold on. Okay. So. Okay, so we have this range right here. So we had this 2 a.m. Right? So this was on 4 hours, 2 a.m., 6. Sorry. And was it on 6 hours? Let me just check my journal. Okay, it was the 8 hours. So, okay. It was 8 hours. And how did I pick it out? So this candle, right? 8 hours. Let's go to 5 minutes. And let's play it out till 10. So, there you go. 4 hours. No. 8 hours. So, you can see what is happening, right? Okay, well, I mean, it already spoiled it. Thank you. If I play it out, there we go. This is my entry. Had a fair value gap right here. You can see 10 opened up bullish, so had this fair value gap. Price dropped back into that fair value gap. I entered right here with my stop loss right here, and this is my target right here. So remember, 8-hour range high, right? Was targeted a bit higher, but then I took my profit right here because market didn't seem that it will go up. So for me it was 3, I think, something like this. And you can see what the market did. Took out the 8-hour range high right here. This is the 8-hour. And what did the market do? See, started reversing. So so if I play it out like this, so accumulation, manipulation, and distribution, right? So you can see we kinda already override, we kinda mixed together the manipulation and distribution. Even if I go on 1 minute, which I don't trade on, you can see what was happening, right? Ranging market started going downwards, taking out stop losses, stop loss, went up, people bought in right here. What did the market do? Took the stop losses, right? And what happened right here at 10? 10, 10, 10. Yeah, it started showing distribution. So, accumulation, manipulation, distribution. In the next episode, we are going to talk about the continuation model for re-entering a move. And if you are new here, like the video, comment any questions you have. I will answer to them in the next video. And sorry again, I'm sick. I'm coughing a lot. And hope you learned something new from this video. Like the video, subscribe, turn on the post notifications on, and I'll see you in the next video.